Hi everyone, and welcome back to the channel. I'm Dean Aronovich's digital avatar, taking the wheel while Dean does what he does best, negotiating top-tier commercial leases across the Greater Toronto area. With over a decade of hands-on experience across industrial, retail, and office properties, Dean knows exactly what it takes to protect your bottom line. If you're an investor looking to secure or scale your commercial footprint, this update is for you. Let's dive in. Today, we are breaking down a highly anticipated real estate update, the Q2 2026 Toronto Central Industrial Market Report. If you just look at the surface level numbers, you might think the market is slowing down. After all, vacancy rates are up and rental prices are softening. But if you look a little closer, something fascinating is happening. While rents might be dropping, investment activity is absolutely surging, making the second quarter of 2026 one of the strongest investment quarters in recent memory. So what is really going on in Toronto, North York, Etobicoke, Scarborough, East York, and York? Are we seeing a market crash, or is this the perfect opportunity for smart money to enter? Let's discuss the data and figure out what it means for investors, landlords, and businesses. Let's start with the big picture. As of the second quarter 2026, the GTA Central Market holds over 225 million square feet of industrial inventory across 4,340 buildings. The overall availability rate rose slightly to 4%, up from 3.9% in the first quarter. While nobody likes seeing vacancy go up, it's important to keep this in perspective. The Toronto Central vacancy rate of 4% is still well below the broader Greater Toronto Area average of 4.9%. We did see negative absorption this quarter to the tune of about 434,000 square feet. Basically, more space was given back to the market than was leased. Because of this, rental rates are continuing to soften. The weighted average asking net rent dropped to $14.75 per square foot, down from $15.5 in quarter one. But here is where you have to read between the lines. This rate drop is not hitting every building equally. The market is splitting into two distinctly different tiers. Older buildings with low ceilings and bad truck access are bearing the brunt of these price cuts, with some older spaces leasing for as low as $8.50 to $12.75 per square foot. However, fully modernized, newer facilities with high ceilings of 28 feet or more are still commanding premium rents in the $17 to $19 range. Quality is king right now. Now, let's talk about the real story of quarter two, the surge in investment. While rental rates softened, institutional and private capital decided this was an incredibly attractive entry point. There were 16 massive transactions of over 20,000 square feet this quarter. Together, these deals totaled roughly 1.05 million square feet and a staggering $333 million. The crown jewel of these transactions happened in Scarborough. GWL Realty Advisors purchased 2750 Morningside Avenue from Oxford Properties for $112.35 million. This 333,000 square foot property traded at $337 per square foot with a 5% cap rate. This deal alone is one of the largest single asset industrial trades we've seen in the region in years. Interestingly, investors weren't the only ones buying. 8 of the 16 big trades were actually purchased by user occupiers. This tells us that business owners themselves see current property values, which have moderated since the post-pandemic peak, as a rare window to finally own their real estate. Let's do a quick lightning round on the submarkets because the activity isn't spread evenly. If you are looking for leasing action, Etobicoke was the absolute king this quarter. 13 major properties were leased there, totaling over 764,000 square feet. The biggest standout was the Birmingham development, where premium new generation spaces with 36-foot clear heights achieved top-tier rates of nearly $18 per square foot. Over in Scarborough, it's all about construction and sales. Not only did it host the massive $112 million Morningside transaction, but Scarborough is also home to literally 100% of the area's new construction. Scarborough has 1.78 million square feet currently being built. Meanwhile, submarkets like York saw specialized action, with FGF Brands acquiring a 2-property portfolio on Alliance Avenue for $18.5 million. So, with trade policy uncertainty and cautious capital markets, Why are companies and investors still pouring hundreds of millions of dollars into Toronto Central? The report highlights 4 massive structural advantages. Labor and density. Being right in the middle of a high-density population center gives businesses direct access to workers and cuts down heavily on transportation costs. Lower development charges. Believe it or not, development charges here remain competitive compared to the surrounding 905 region alternatives. 3. Strategic transit access. You can't beat the connectivity. Major highways and public transit infrastructure are right at your doorstep. 4. Demand for modern distribution. Developers know that e-commerce and modern supply chains desperately need infill sites located near the end consumer. As we look ahead to the rest of 2026, the market has transitioned to a much healthier, balanced environment between landlords and tenants. If you're an investor, this rationalized asset pricing and fresh 5% cap rate benchmark offers a really compelling entry point. If you're a landlord, the data is clear. Maintain and modernize your facilities if you want to command premium rents, because secondary stock is getting discounted heavily. And if you're an owner-occupier, the window is open right now for tactical acquisitions before the market moves toward full recovery. If you want a deeper dive or to get a complimentary opinion of value for your own property, reach out to me. Call the number on your screen or book a free consultation on the link in the description below. Don't forget to like, subscribe, and hit that notification bell for more real estate market updates. Thank you for tuning in and see you on our next video.